Hey everyone, and welcome to This Explainer. Today, we're zeroing in on an absolutely crucial skill for any business leader, manager, or accounting student, and that is canceling out financial noise. We're going to look at exactly how to filter through absolute mountains of data to find the specific numbers you need to make really smart, short-run business decisions. Now, when you're faced with a complex choice, I know the instinct is usually to look at every single number on the spreadsheet, right? But as we'll see today, doing that is just a costly illusion. To get us there, here is our game plan for today. First, we'll cover the cost classifications. Second, we'll practice identifying relevant costs. Third, we'll look at exercise M116-1, process further. Fourth, we'll test out M16-3, make or buy. And finally, we'll tackle the Spark case. Let's jump right in. Section 1, the cost classifications. Take a look at this big picture map of the entire accounting ecosystem. It goes all the way from cost behavior on the left right over to decision-making on the far right. And that right side, that is our playground today. Out of all the different costs a business tracks for things like product costing or time horizons, we really only care about a very specific subset when we're making choices. We're talking about differential, allocated, sunk, and opportunity costs. So let's break these down so you know exactly what to look out for. First up is the ultimate distraction, the sunk cost. This is a cost that has already been incurred. You've paid it, and it absolutely cannot be reversed by anything you do in the future. Think about college tuition you've already paid for a class. If you're suddenly deciding whether to drop that class and take a job instead, well, that tuition money is gone. Even if you drop the class today, you aren't getting a refund. Because that cost literally doesn't change based on your future decisions, it's entirely irrelevant. You just have to ignore it, no matter how much it hurts to look at. Next, we have allocated costs. These are costs assigned to a product or activity using a systematic process, like building or equipment depreciation. These just kind of happen automatically in the background. If you have a factory building, it's going to depreciate whether you choose to manufacture product A or product B, right? They don't change based on your immediate short-term choices. And that makes them, once again, just irrelevant noise for our decision-making purposes. But now we get to the real hero of our story, the differential cost. This is a cost that actually differs depending on the alternative you're looking at. So the absolutely crucial point here is this. If a cost changes between option A and option B, like having to pay an outsourcing fee if you hire a third party, but paying zero fee if you do the work in-house, that cost is highly relevant. It is the core of your decision. Finally, there's the opportunity cost. This is an economic concept that honestly gets overlooked way too often in strict accounting analyses, but it is vital. It's the potential benefit you give up when you choose one alternative over another. For example, if you decide to take a full-time MBA course, you might have to give up a part-time job that pays $2,000 a month. Now that $2,000 isn't a bill you literally pay, but it is revenue you lose. That is your opportunity cost, and it's absolutely a relevant factor you've got to include. All right, moving into section 2, identifying relevant costs. I want you to put yourself in the shoes of a family deciding whether to drive or fly for a spring break ski trip out to Colorado. The whole trip is scheduled for 8 days. If you drive, you're going to spend 2 extra days on the road and pay $200 in gas for the round trip. But if you fly, you save those 2 days of travel time, which actually gives you 2 more days on the slopes, but you have to pay $700 for airfare and a rental car. Now, this scenario brilliantly illustrates the power of canceling noise. You might be thinking you need to calculate the motel costs at $90 a night, or meals at $25 a day, or even, boarding the dog at the kennel for $7 a day. But wait a second. Whether you drive or fly, you're still on the strip for a total of 8 days. Those costs are exactly the same either way. We can just completely cross them out. And what about your $75 monthly car insurance? That's a sunk cost. You pay it regardless of whether the car is just sitting in your driveway or driving all the way to Colorado. Cancel that noise. And look at what happens. Once we clear away all that irrelevant noise, the math becomes incredibly simple. The only relevant financial difference is the $500 gap between the airfare and the gas. The ultimate decision doesn't require some massive spreadsheet anymore. It just boils down to one really simple, personal question. Are 2 extra days on the slopes worth exactly $500 to this family? That is the kind of clarity that relevant costing gives you. Let's step it up. Section 3, exercise M16-1, process further. We're going to tackle Lakeside Company's manufacturing dilemma. So, Lakeside can sell a product right now for $36, or they can process it further to refine its quality, which allows them to sell it for $40. The selling price goes up by $4. That's a positive differential. Sounds great, right? Well, hold on. This refinement increases direct materials and direct labor costs by 20%. Notice how the $10 material cost jumps to $12? That's a $2 increase, a negative for our profit. The $12 labor cost jumps to $14.40, a $2.40 increase. It's super important to keep our signs straight here, plus for revenue, minus for costs. And here is the dramatic plot twist. That $4 in extra revenue, it is entirely eaten up by $4.40 in extra costs. Processing the product further actually results in a 40-cent loss per unit compared to just selling it as is. By mapping out only the differential costs, it becomes crystal clear that the smartest choice is actually to just sell the product right now. All right, let's keep that momentum going with Section 4, Exercise M16-3, Make or Buy. Let's see how this builds on our previous logic. Lakeside now has to decide whether to manufacture a specific part of their product in-house or outsource it to an external supplier. Notice that we are completely ignoring the raw material costs and fixed overhead costs here. Why? Because the exercise tells us they will not be affected even if we outsource. That's just irrelevant noise, so we drop it. We only look at what changes. Buying the part means paying a new $4 outsource fee. But making that move reduces our direct labor and variable overhead costs by 30%. That equates to $3.60 saved on labor and $1.50 saved on variable overhead. Total savings? $5.10. So when we compare that $4 fee against the $5.10 we saved, we get a beautiful number, a positive $1.10. Outsourcing actually saves the company $1.10 per unit. The numbers do not lie. By ignoring the fixed overhead and raw materials that literally do not change, we easily proved that buying the part is the smarter financial move. Finally, Section 5, Tackling the Spark Case. Okay. It's time to escalate to the boss level. We are going to look at the analytical framework you need to navigate the complexities of outsourcing the P&D, or printing and distribution department, in the Spark case. Now, this case is dense. It's got a lot of moving parts and some tricky wording, but this step-by-step approach lays out exactly how to tame it. Step 1, set up your 2 columns, keep versus outsource. Step 2, go through the case line by line. There are 9 specific items detailing different costs and revenue impacts, and you have to evaluate every single one to find those differential costs. Step 3, keep your signs straight. Use positive signs for savings or incoming revenue, like maybe if they sell off some old machinery, and negative signs for new costs. You really have to be rigorous and spot what actually changes. Let's look at a direct example from the very first item in the case. The company has 2 veteran staff members, Minik and Hala. If we keep the department, we pay them their current salary. But if we outsource, the CEO intends to pay them a massive pension buyout for 2 years before they retire. That creates a huge differential cost that you absolutely must calculate. Now, compare that to the 2 specialist staff mentioned right after them. If we keep the department, we pay them. But if we outsource, the case says we still have to retain them to coordinate with the new vendor. Their salary stays exactly the same either way. Therefore, those specialist staff are just irrelevant noise. You literally just put a 0 in the difference column for them. By systematically evaluating every single item this way, reading carefully to separate the changing costs from the static ones, the true financial picture of the Spark case will completely reveal itself. So, I'll leave you with this. When you're faced with a mountain of data, complex business alternatives, and pages of text, will you cancel the noise and make the right call? You now have the tools, the step-by-step framework, and the analytical mindset to do exactly that. Get out there, build those columns, and master the art of relevant costing. Thanks for joining me on this explainer, and happy learning.